Welcome to the Monocle Banking Podcast, your weekly foray into the world of banking and finance and insurance, as always, curated by Monocle Solutions. I'm your host, Michael Avery, and today we're talking about a policy against obsolescence and peering into one of the most quietly revolutionary spaces in financial services, personal lines insurance. And we're doing so through the lens of two leaders that are really shaping the future of intelligent underwriting. Stay tuned. Well, joining me this week are Christelle Colman, CEO of AMI, a boutique underwriting agency with big ambitions and a digital-first philosophy, and Ron Richman, the founder and CEO of insureAI, a homegrown actuarial tech firm fusing classical pricing theory with AI-powered precision. They've just announced a major partnership which is aimed at transforming the way that personalised products are priced in South Africa. Think fewer blunt instruments and more intelligent tailoring. So I'm really looking forward to this one to unpack the why, the how, and what it all means for brokers, for clients, and the industry, and of course, how artificial intelligence, which is what we're all talking about at the moment, is going to impact the insurance industry. So to you both, thanks so much for taking time out of your busy schedules. Ronald, I believe you've just come back from presenting at an actuarial conference in Sao Paulo. And Christelle, you are ensconced in your cocoon, I'm sure, down in Hermanus, where the winter weather has arrived. Maybe ladies first. If you could kick us off. You're very well known in the insurance industry. You've been described as a maverick. You founded Thatch Risk back in, 1998, and you've gone on to found other businesses during that time. Elite Risk Acceptances, I think, was the most recent one, until Amy came around, or AMI. I don't know how you pronounce it. You'll correct me. What drew you to the insurance world in the 90s?
Well, Michael, if you end up in the insurance industry, the chances are probably almost 100% that it's by accident. I started working at Santam straight after school and opportunities presented itself. But let me just tell you a bit about the name. So that it's actually Ami underwriting managers, like mon ami, the French word friend. Because we identified a gap in the market for insurance that is friendly, delivered with the best digital tools, making it fast and precise, as you said earlier. So it's the human touch, sort of embracing technology. It's really been a phenomenal journey. We launched the business just over 2 years ago with our partners and risk carrier Lombard Insurance, which is a license in the South African marketplace. And we're well out of the starting blocks, and now it's time to get a little bit more precise with where we want to go with the business. And in insurance, one of the main pillars is, of course, pricing. And the timing is great for doing this. So yes, that's me in a nutshell.
Yeah, well, in a very brief, very, I think, self-deprecating nutshell, because you've done a whole lot more than that, Christelle, but I think you've done well to sum it up very quickly. Ronald, you're also very well known in the actuarial circles. You're a fellow of the Institute and Faculty of Actuaries and the Actuarial Society of South Africa. You deliver talks all over the world. As I said, you've just come back from Sao Paulo. Obviously, you had a love of maths growing up. How did you get into the world of actuarial science? Was it one of those things that, ran in the family, you knew that's just what you were going to do, or was it a difficult choice for you?
Michael, such an interesting one. I think I always had a love of maths, but it was sort of an equal toss-up between law, medicine, and actuarial science. And I suppose after attending some of the open days at Wits, led by Stephen Juresh, who's still the head of the school, I was just hooked on the possibilities that the mathematical inclination that I had opened up. And that's something I've always enjoyed throughout the career, whether it was studying back at varsity or writing the exams. And from a day-to-day working perspective, there's always those great opportunities to get a little bit technical, look at the mathematical understanding of problems, whether it's pricing and insurance or reserving or capital, any of the other great things that we get to, I suppose, deal with on a day-to-day basis, and just enjoy the ability to quantify things and understand systems better, understand what drives complex things like insurance in a lot of detail, and then zoom out and get the big picture. And it's just something that talks to me. So very happy that I made the career decision and followed that mathematical inclination, and this seems to be where the world is going.
And you're not spending your time measuring your life by billable hours in some dreary law firm somewhere, I'm sure.
Luckily, no.
With respect to all of the lawyers who love the Monocle Banking Podcast, it's also a career of lifelong learning for you. You qualified with your Bachelor of Science back in 2005, enrolled for your PhD in 2020. It's just the nature of the beast, isn't it? Your dissertation for your PhD was applying deep learning in actuarial science before it was really made sexy by ChatGPT, just showing how actuaries and the academy were thinking about where we were heading with artificial intelligence. Maybe just on that point, you've written compellingly about the actuary in an age of AI. What does that actually mean from like a first principles perspective? Are you saying that AI is going to be the ultimate tool to help augment the profession? How do you view those two intersecting?
It's a nice question, Michael. So I suppose I became aware of deep learning, which is exactly as you say, that technology that powers ChatGPT in around 2016 or 2017, back when I suppose what you could call the deep learning revolution was getting started. And it just struck me as such a compellingly different paradigm for mathematical modeling, which is what actuaries and statisticians and data scientists have been doing for all these years, but using less technologically advanced solutions. So maybe just to explain that in a few short sentences from first principles approach, let's say you're looking at an insurance portfolio and you'd like to quantify which policyholders might exhibit greater or lesser risk than the mean. What you might do is build a statistical model and predict each policyholder's risk profile. And the promise of deep learning, which is, as we've said, this foundational technology in AI, is that instead of sitting there fiddling with parameters and fiddling with different forms of models, you can effectively allow the computer to do all of that decision making for you. And this is incredibly powerful, particularly when you're dealing in domains where the data is complex or there's a huge amount of it. And that really is why the AI revolution has got where it's got. These models are powerful enough to process basically all the text humans have ever put on the internet. I found it compelling then, and it's just interesting to see how AI as a technology has caught on in the popular imagination since then. So for me, I find it very exciting and pushing the boundaries of what's possible using this technology in, I suppose, the field that I work in. For me, that's exceptionally interesting.
Even to the layperson and the outsider who probably doesn't get nearly as passionate as you do about actuarial science and insurance, it is fascinating. You know, the fact that I had Daniel Kahneman of Emerge AI on the show talking to me about the predictive power of these models to based on the day of week, for example, that you apply for a bank loan, within a 98, 99% accuracy, predict your likelihood of default. And, it's almost like magic. I want to come back to your career, which, before founding insureAI, you were chief actuary at a major player. What made you decide it was time to start something of your own? And what's been the biggest challenge, maybe, of shifting from in-house to entrepreneur?
Wow. I think I had that little voice in my head for several years saying, you've done the research, now go put it into practice. And I think something I've learned is sometimes you have to also listen to your heart and to your intuition. And as that voice grew louder and louder over the years, seeing the rise of AI in the public consciousness as perhaps the fastest growing consumer app ever, that voice got louder and louder, and eventually I listened to it. It's very different being an entrepreneur, as I'm sure Christelle can relate, that when you're working in a big insurance company, there's premium income coming in regardless of how great a job you do in any particular week or any particular month. I think as an entrepreneur, every rand of income or sales that you do really depends on the quality of the work you're doing and how much of it you're doing. So I think that's really the fundamental shift, is that it's more rewarding because the direct results of your efforts are easily and readily apparent. But in of itself, that creates a little bit of the stress and the tension in running a business like this. Overall, the upside is greater than the downside, but it's almost a complete paradigm shift.
Yeah, to me, it's the ultimate in alignment, as you say, where there's direct correlation between input and output that you experience as an entrepreneur. And as something of a media entrepreneur myself, it's exactly that. It's exhilarating, it's rewarding, it's terrifying some months when things are quiet and you're wondering why you got into this. But let's talk origin story. Christelle, is that something, when we look at how this partnership came about between AMI and insureAI, that you had this shared entrepreneurial passion and obviously saw an opportunity here to merge the various skill sets that you both bring to the table. How did that meeting of minds come together?
My previous startup was, as you mentioned, Elite, part of the Old Mutual Group. And that's when Ronald and I, when our paths crossed. So I think we immediately hit it off. We both move very fast and think fast and, want to get results. And I started doing my MBA at Stellenbosch University. And, then you have time to think. I think that's one of the biggest advantages of doing your MBA at a later stage in life, because you get to actually think about the market that you're in, the opportunities that there are. And I wanted to start a business that was going to be different from being a client of one of these big insurers where there's no face to the name, there's no relationship, there's no number that you phone and you get through to someone that you've spoken to before. These are very sort of simple things, but it created such an opportunity from my perspective to launch a personal lines specialist underwriter that will really be there to let me go a step back. If you think about personal lines insurance, it's all our personal assets. But because we are in a country that is so riddled with crime and almost everything that happens has got some sort of criminal aspect to it, as insurers, many of the processes have been built in such a way to catch out fraudulent claims, forgetting that we live in this volatile country. And whether it is your daughter's cell phone that's stolen as a first year at Stellenbosch University, or you've just been in a hijacking, or your home has been invaded, these are hugely traumatic events. Yet we lost that human touch, the empathy. I'm not just saying this, it's something that sits extremely close to my heart. And that's really the premise of our business, is to say for good clients who want to be really, really cared for, we will give you very competitive rates and premiums. And we'll give you the best service. The need for someone like Ronald, and why it took me a bit of time, but still we could get this partnership to market, a very competitive market space. I don't have to tell anyone that's listening to your podcast, because it's so crowded from an advertising perspective. So how do you differentiate yourself? And one of the first things that you have to do is that your quote that you put out, your first quote, needs to be as accurate as possible. Otherwise you lose that client. And that you can't do from experience. For that you need the best pricing models possible, the agreements that we're discussing today.
And I'm so glad you put the human face on what on the outside, on the tin, on the label, can often feel like it's a very inhuman discussion. We're talking AI, we're talking dynamic pricing models. But to your point, in that insured journey, when you are tapping into something that one purchases, it's generally at a time of deep distress. Insurance is not something you're tapping into because yay, you're going to be drawing money to fund a milestone occasion, for example. It's not like engaging with your banking app. It's a completely different experience. And I think a lot of insurers have actually lost sight of that. But Ronald, I want to come back to the nub of the partnership is about, and that is also dynamic pricing models. What is a dynamic pricing model in a world where we've got AI algorithms that can, literally, as you say, they're trained on the corpus of data that we have online, and they can adapt to real-time market conditions. What does that mean in practice?
Absolutely. So I think something when we think of AI, we automatically think of these very general models where you can ask it what a good smoothie recipe for breakfast is, and recommend a place for lunch, and do a little bit of your documents at work in between. I think in the insurance world and maybe more generally in financial services, we still need models that are much more specifically focused than these very general models. What we need to do is take and adapt a lot of these AI principles that have consumed basically a significant portion of human knowledge. We need to work out how do we adapt them to performing very narrow tasks in an optimal manner. So a narrow task might be coming up with the rate for flood for a particular policyholder in South Africa, or the rate on a new BMW car. These are the sorts of narrow tasks that we need to be able to create predictions for. And that's something that I suppose statistical models have been used for a very long time. The magic that we're trying to bring is how can we make these models significantly better, where you can update them much more quickly to adapt to changing conditions. As you'll have known, Michael, the insurance market has been in almost a state of disarray since COVID, with rates going up, rates going down. There's been all sorts of inflationary influences. The rand's volatility hasn't helped very much. how do we capture all of that in something that can say today, at the end of May in 2025, we can stand by this price and say, it's been calculated correctly. We can do those calculations very quickly, update according to changing circumstances. That's part of what we're trying to bring to the table in this partnership. We've developed a suite of models that does allow for that quick updating using principles from these larger, more general AI models. And it's something we're very excited to bring to market.
It speaks to what I see as a very interesting emerging risk factor that one needs to try and understand to price for, and that is climate change. Yeah, I was a guest of Vikili Property Fund not too long ago. One of the assets they acquired in Valencia suffered a 1 in apparently 250-year flood event. And my question to the CEO is, are you sure that this is going to be a 1 in 250-year flood event into the future? And so aren't we now living in a world where, climate risk is becoming, say, if you're a high net worth homeowner in Cape Town, a much more important thing to consider, be it floods, be it fire, that kind of thing? How are your approaches taking this into account?
100%. I think we need to move beyond the realm of focusing on the extremely poor outcomes like the 1 in 250 year and get better in the realm of insurance pricing at saying, what do we expect is going to happen over the next year for this particular policyholder? Right. How do we make sure that the price is right? And also, how do we draw insights from that to help advise policyholders on maybe you can take these steps to improve your risk? In my experience and the philosophy I've personally adopted is you need to have new and innovative alternative data sources, maybe coming from big climatic data sets like the CHIVS precipitation data set or other data sets. And you need to be able to almost figure these into your models in that way that allows for some impact to flow from the particular status of a policyholder. Where do they live? What has the rainfall been? What do we expect it to be? But also give credit for those protections that a policyholder may put in place. Are there French drains, for example, or how close are the tree branches to the nearest chimney? Or those sorts of things can make a big difference. And it's exactly the sort of much more flexible modeling technology that holds the promise of making these connections correctly, giving people the correct credit for the protection they've got and charging the right price.
Can we do that for crime as well, Ron?
So factors like this are already incorporated into many South African pricing models. So there are proxies for the expected level of criminal activity in a particular region or a suburb. Keeping that dynamic is a little bit tougher. So we might actually have better climate data than crime data down to in very small areas. And that's just because of the way we update statistics. But there are good proxies, and this whole world of bringing alternative data into insurance pricing is exploding right now. The number of different data sources overseas are massive. And we also have South African companies that are starting to go with this trend.
How does, and this is for you again, Ronald, how does this world of dynamic pricing improve overall transparency and fairness for policyholders? Because I think that's a big part of this collaboration and what you're trying to do.
Exactly. I think there's a couple of points in there. From a transparency perspective, you want to be able always to explain the rationale for decision making that are to your policyholder, but also very importantly to all your other stakeholders in a company. Whether it's a CEO like Christelle or her head of underwriting, you need to be able to explain very clearly the rationale and why do things work. And over the years, we've developed several techniques for being able to explain this, even in the context of very complex dynamic pricing models. Fairness is a really interesting one, Michael. I think a lot comes down to how do you define fairness. The old vision of fairness in insurance is actuarial fairness, which is that if you have got X number of units of risk, we need to price you accordingly. And if another policyholder has got more than X units of risk, that policyholder should have a higher price. So that's the old idea of actuarial fairness. You basically pay for what you cost. I think society is starting to demand other elements of fairness. So, for example, in the vast number of factors that you might look at when you're building a personal lines pricing model, there's nothing in there that is highly correlated with race or ethnicity or religion or nationality. And that's a new sort of socially demanded fairness that's also a very big topic in the artificial intelligence world, and also a topic that we're very passionate about, particularly when you think about the use of geography as a rating factor in South Africa and the perils and pitfalls you might run into with that. So I think these models allow for greater transparency because you can objectively explain the decision-making basis. They allow for better fairness because they are better predictors of cost, but they need to be tempered in a way that societal fairness is also maintained.
Yeah. So it's not a black box, Christelle, because I know, to bring you in, and to Ron's point, there's a lot of talk globally about algorithmic bias. And whenever we hear and talk about the ethics of AI, it's all about, well, what data has it been trained on? Is that historical data part of a society that had a natural bias? And do we want to perpetuate that? And I think building explainability and fairness into a model, especially in a market like South Africa with our social and our economic complexity, is so important. How are you taking this to market? Because I think one of the challenges, and often with brokers, they caught between innovation and inertia. How are you bringing them along on this journey, especially when it comes to understanding this kind of very different kind of granular AI-informed pricing model?
Well, sure, that's a question with many questions on the inside. But let me start off by saying that, having this conversation with you is an example of how we try and demystify this whole approach. So thanks for having us on your podcast. It's very much appreciated. When you talk about fairness, if you look at it from a human perspective, you would imagine that if you are a good client, no matter what your race or gender, but you're a good insurance behavioral client, you want to then pay less for your insurance coverage because you claim less. And I think achieving that sort of benefits in the model will be really amazing so that we attract and keep the best possible clients out there. The next point I wanted to make was just, this is an ongoing exercise, Michael. So we're starting off with the rating model, but what AI gives us is to refine it on an ongoing basis and make sure that we keep our pricing as competitive as that possibly can be, or it can be. And then the last comment I wanted to make was your question around the models out there that might have the bias sort of ingrained in it. That's why we have a company like insureAI that we've partnered with to make sure that we get the pricing completely bespoke to what our needs are and, what we take to market and what's important to us. So it's not just me going to an AI engine and, trying to extract a rating model. There's human intervention and lots of meetings and discussions and unpacking the different factors. And so it's not just as simple as, getting it out there. You need really smart people that can do this. And then brokers and clients won't even know what's going on because the rating model engine will deliver a rate based on the risk factors that we have agreed upfront with insureAI. So what are the things that's important to us? Ron, I got that right.
Absolutely perfect. Absolutely perfect.
And then from a front end, maybe you could just share terms of explainability, how accessible that is to the end client or the end user at the end of the day.
Sorry, Ron, I just wanted to say we only deal through brokers at AMI, and we always produce the quote to the broker who discusses it with the client. So There's no real change there. But over to you, Ron.
I think what's very interesting is when you do get a query that bubbles up through all of the channels of the company into the actuarial team's emails, and once in a while you'll need to explain why was a quote given different today from a quote given a few weeks ago. And there are also those occasions where you called on to explain, I moved suburb and suddenly my premium rate got a lot higher. And that's the sort of thing, if you do have a model that's explainable, that's exactly the sort of rationale for decision making that I was referring to earlier, where you can pull that out and explain very clearly our view on a particular postal code or suburb is slightly worse compared to where you lived previously. So that's the sort of thing where once in a while you get some of these queries and comments. It's very interesting when you look at it from a legislative perspective. In the EU and the United Kingdom, these types of model explanations do have to be available. Whereas in South Africa, it's usually done in response to a client query. The global perspective on this is make explanations much more available, whereas I think in South Africa, we might need to adopt or move towards some of that sort of perspective.
Christelle, one of the standout benefits mentioned is the ability to apply smaller, more sustainable increases for existing clients. How does this approach shift the traditional dynamics of repricing in insurance?
Oh, Michael, you asked the best questions. Thank you. The point I was trying to make earlier was, I still remember the days when we had paper rates. So, but basically a printed out rating structure, and more or less everyone of the same age in the same suburb doing the same kind of job, driving a car of similar value would really just end up paying the same rate that we would apply to that item. I think now one of the big benefits is the ability to really isolate our good clients. And we don't have a lot of differentiation in the past compared to where we're going with regards to really giving the best clients the lowest possible premiums. And that's why I don't want this discussion to come over as, insurers are just pricing for profits. That's not the case. And there's another myth that we have to bust. If you look at the results of short-term insurance companies, we work very hard for a very small margin. So it's not that insurers are just pocketing profits. As a shareholder in this business and wanting to build a sustainable company that's going to be around for 20 years and creating jobs to people entering the workplace, if we can get it right to get together a pool of clients that are of like-minded behavior and they stay with us because they can't get a better quote anywhere else, then we have a successful business. So
yeah. Well, and in a competitive environment, what you can do
Yes.
is then pass those, those competitive premium costs through or savings onto the end user. One can see this working out in medical insurance as well, in the way you lower the overall cost for the pool. I want to, Ronald, bring you back in and just maybe from a more regulatory perspective, ask you how you see this playing out when we think about regulation like SAM and, the solvency assessment and management regulations for South Africa's insurers and SAM too. And that obviously requires a careful balancing act between innovation and prudence. Under SAM, insurers must hold capital proportionate to their underwriting and their market and their credit and all their operational risks. And you're talking about now dynamic pricing, which when implemented responsibly, actually improves your risk calibration because you're aligning your premiums more closely with individual risk profiles. What might this lead to, more broadly speaking, if we say it starts to become more widely adopted over the next 3 to 5 years?
Michael, that's an incredibly insightful question. I'll give you my take on it. SAM, as you've rightly said, forms the capital basis for our insurance and reinsurance market in South Africa. When you zoom in on the non-life underwriting risk component, which is really what defines capital requirements for short-term insurers like the one where AMI is based, you see that a lot of it is based around potential volatility around your outcome. So let's say you think you'll be able to write business and earn 90 cents on the rand, pay out 90 cents on the rand and earn 10 cents on the rand. Could that potentially be that you'll only earn 5 cents on, or even lose money on each rand of premium that you get in? I think the promise of these sort of dynamic pricing perspectives is if you can get that with a lot more pinpoint accuracy, how certain you are that you will earn or that you will realize your claims as the same amount that you forecast, that becomes much more precise. So I think the promise over here is that it leads to much more stable markets. You're no longer charging, like Christelle was mentioning, a flat paper rate to many policyholders. You can really tailor that to the specific risk profile. And overall, that leads to decreased volatility and potentially even the ability to free some capital up and use that for other sorts of profitable operations. So I see this direction as going in the ability to underwrite more efficiently from a capital perspective, to need to hold less capital based on what it would have been a few years ago. Of course, there's offsetting impacts. So as you for example, mentioned climate change. So you may not see much capital being released, but instead of having to raise capital for climate change impacts in the future, insurers might just be able to keep it the same. There are some complexities. This is maybe at a theoretical level that only some of the much more advanced companies in the market can realize, but the principles that we've just discussed are exactly correct.
Fascinating. And we could certainly go down a black hole around theoreticals on this, but I don't want to head there just yet. Christelle, I want to bring you in as we wrap up. And again, looking ahead 3 to 5 years, what's the moonshot here for you? What will insurance look like when we fully embrace this kind of precision and dynamic pricing that you're building through this collaboration?
Oh, I would love insurance not to be a grudge purchase anymore, as you mentioned when we started this conversation. For me, it really is about making insurance friendlier and trusted than it is currently. Insurance is got a noble purpose to it. If you think about it, when we had the KZN floods and the uprisings and the floods in the Western Cape, and when things go wrong, insurance companies step in to help rebuild, if you're lucky enough to have insurance, to help rebuild and get people back onto their feet. But yet at the same time, we have a terrible reputation as insurers. I will know we've made a success of this business when we sit back 5 years from now and we have happy, satisfied clients who refer us by word of mouth because they trust us. And you can only earn trust through your results. So the best pricing, the best risk selection, the best claim service, and really doing all of that wrapped in care for what we go through in this country. That would be a measure of success for me.
Yeah, and I think that is a very important measure as well. And we often think of, collaboration, I think, is one of those words you hear about at insurance conferences. It's spoken about ad nauseum, but I think rarely done very well. To see this kind of collaboration really is, I think, one, inspiring and hopeful, but I really do hope you succeed here. Just, Ronald, to give you the last word, I know there's a lot of hype. Maybe you could just share what you'd like to see from this collaboration in the next 3 to 5. And if you could use AI to solve one underwriting headache tomorrow, what would it be?
Yeah, at the end of the day, I think I'm very much aligned to what Christelle said, that insurance is a really great industry with a noble aim, and it's a social good. If we can make this industry better for everybody, whether it's the people we service, whether it's the insurers themselves, that's really what the goal is. How can we do this more efficiently, more effectively, bring insurance to a greater number of people and close the protection gap? If we can accomplish any of that with these sorts of goals, I think we'll have hit the mark and done the right thing. If I think about what AI could be used to solve in the underwriting space, I would love to see a proliferation of explainable and societally fair models. I think it's something where you can very easily, if you're not on the lookout for societal fairness, come across areas where your models might not live up to what your own personal values are. That's something I think we can fix. And then just taking into account this proliferation of information to give people the right price. That's the promise, and the peril is if we don't do it in a fair way, that's exactly what we have to solve.
Well, fantastic chatting to you both and getting some insight into that mission as you've come together as AMI and insureAI. Thank you very much for sharing those insights here on the Monocle Banking Podcast. A huge thanks to Christelle Colman of AMI and Ron Richman of insureAI. And remember, if you've enjoyed today's conversation, don't forget to hit that subscribe button and share. From traditional tables to dynamic data sets, the future of underwriting is being rewritten in real time, one algorithm at a time. We just need to make sure that we do it in a way that's fair and transparent and explainable. Until next time, I'm Michael Avery, and thanks for listening to the Monocle Banking Podcast.